Thank you very much, Rick. It's a pleasure to be here today. Hello, everyone. I'm Troy Donahue. I head up America's Portfolio Trading at BTIG. In that role, I help with institutional clients to implement their investment strategies and help grow their product offerings. Today, we'll be talking about actively managed ETFs. It's an area of the ETF ecosystem that I'm particularly excited about, and it's something that's growing very quickly. So we'll talk about the benefits of the actively managed ETF structure, a little bit about product design and how these panelists are thinking about that, and what the future holds for actively managed ETFs. We have a great panel up here with 5 panelists that are all experts in their various different fields. So without further ado, I will allow each of the panelists to introduce themselves, give a little bit of background, starting with Mark.
Sure, thanks for having me. Mark Ott, I'm the head of trading for Kovitz Investment Group. We're a registered investment advisor and headquartered in Chicago, and we manage about $30 billion at the moment.
Hi, I'm Rich Kerner. I'm with Touchstone Investments. We're a $30 billion asset manager out of Cincinnati, Ohio, and I've been in the ETF space for a little bit over 20 years now.
Stephen Brown, in the Client Solutions Group at Goldman Sachs Asset Management on our ETF investment strategy team. We've been in the ETF space since 2015, but we are no strangers to asset management.
Good morning. My name is Amrita Nandakumar. I am president of Vident Asset Management. Vident is a platform for investment ideas. We partner with sponsors of investment strategies looking to bring them to market and make their strategies investable, whether it be ETF, UCITS, hedge fund, SMA, or other vehicle. But our specialty is ETFs. I'm very happy to be here this morning.
Good morning. I'm Ryan Isakainen with First Trust Advisors. We are primarily an ETF asset manager. We manage about $250 billion overall, about $193 billion in ETF assets. I lead a team that is responsible for providing the intellectual capital and content related to our ETFs, and I've been at First Trust for about 25 years.
Thank you, everyone. So I always like to give a little bit of background on the topic, so I'll take you down memory lane for a quick minute. 2008, the first actively managed ETF was launched. So if you were investing during that time, you probably have a sense on why it was slow to be adopted, but we've certainly made up for lost time. Fast forward about 16 years later, we've grown from one product all the way up to 1,750 actively managed ETFs in the US. So I've actually done this panel the last 3 years, so I figured it'd be good to go back and look at my notes on what we were seeing. So in 2022, when I did it, there was 1,000 actively managed ETF products, $330 billion. Last year in 2023, it was up to 1,236 products for $560 billion. And fast forward today, we have 1,750 actively managed ETFs for $830 billion. This is the room you want to be in to hear more about it. This is where the growth is. A quarter of the ETFs that are actively managed launched in 2024 alone. This is the room to be in to learn about ETFs. This is where the growth is. You can invest right now in a 2x daily return of NVIDIA or Tesla. You can invest in the Magnificent Seven, equal weighted, run with swap. You can invest in a strategy that focuses on the Democratic congressional trade ideas. All of those are products that have outperformed the S&P year to date. So investors are looking for those types of products to add alpha to their portfolio. And these panelists are laser focused on developing those actively managed products to help bring them to market to complement their investment strategies. So we'll start it out with Rich. Touchstone is an ETF provider that pairs with sub-advisors to launch their strategies. How do you determine which sub-advisors or asset managers you want to partner with? And once you do, what role do you play in the investment strategy?
Yeah, thanks. Touchstone's celebrating its 30th year this year. We just got involved in the ETF business 2 years ago. Obviously, we started the effort a little bit longer than 2 years ago. We have right now 15 sub-advisors that we work with. Touchstone's owned by Western and Southern, 140-year-old mutual insurance company. And so we are what I think of the classic insurance-owned asset manager. So we use sub-advisors exclusively inside our portfolios. We saw the trend towards actively managed ETFs. Our tagline is distinctively active, so we wanted to, because the rule changes, take advantage of the fact that now we could put our strategies into the ETF wrapper. So how do you go about picking from which one of the 15 sub-advisors to choose from? Certainly, we've got a lot of great, well-known sub-advisors, probably even maybe more well-known than who we decided to launch with at first. So Sands Capital is probably a little bit more well-known than Fort Washington Investment Advisors. But we chose to launch with Fort Washington Investment Advisors, which is our sister company, really primarily for that reason. I mean, they're a $90 billion institutional money manager, so they're very well known in sort of that institutional space. A little less well known, even though they manage 4 different mutual funds for us, but just not as well known to the advisor community. But because of the synergies, I always tell folks, when you come out to Cincinnati, we're on the 11th floor, Fort Washington's on the 12th floor. We share a lot of the same resources. So for us, it just made a lot of sense to take kind of our sister firm, partner where we share these resources to enter a brand new space for us. So that's why we selected Fort Washington. We also think they're kind of best in class when it comes to sort of the various niches that they specialize in: asset-backed securities, securitized products on the fixed income side. But it was really sharing those resources across the organization that made a big difference for us. And at 30 billion, it's a nice size number, but it's not as large as some of the other panelists. So when we launched, we kind of took our time to launch those first 4 products one at a time. So we did them, on a single day. We did a couple with NYSE, a couple with SIBO. But as we've grown, we're up to 7 ETFs now. We brought in other sub-advisors into the mix outside of the Fort Washington family, and that process has gone extremely well. We filed for 3 more products that will launch in 2025 with some of those more well-known sub-advisors.
And I said we had a diverse crew, so we'll go from partnering with sub-advisors to an actual sub-advisor in Vidant. Amrita, Vidant offers a unique approach to this panel because of all your work as a sub-advisor for actively managed products. Can you talk a little bit about the flavors of active and how you and your team work to put a product around those active strategies?
Sure. So to clarify, it's interesting when you think of the Vidant model, it's actually in some ways the opposite of the traditional sub-advisor that my colleague will typically partner with. So we partner with active managers that are looking to bring their ETF wrapper, their strategy, I should say, to life in an ETF wrapper, but they don't necessarily have the resources or want to make the investment into launching an ETF. So if you're already managing mutual funds, it's not a huge step forward to launch your own ETF, but what folks find is that they can do it, but it's distracting. And if you're a manager that already has a successful strategy in a mutual fund or an SMA or some other vehicle, you have very good reasons, I'm sure, for launching an ETF, but do you want it to become a distraction and take you away from focusing on what's going well? And so that's where we step in. We're outsourced portfolio management, trading, capital markets, and operations. So essentially, we work with active managers, particularly those who participate in model delivery. We are just another recipient of that model, and we actually implement the strategy in an ETF. So when we're talking to a new firm, we often start with trying to understand how they generate alpha. And how do we reconcile the components of the strategy that drive that alpha in accordance with the regulatory structures that are around the ETF, as well as certain operational limitations. And in some cases, that's easier than others. So what we've all known for a long time is that there's not one definition to active. And I think with ETFs, we're seeing that play out even more. So there are times where we'll work with an active manager who is, your traditional stock picker. We'll work with an active manager who actually really likes a particular index because it captures the exposure that they want to provide, but they want the ability to make subjective decisions about what to include or exclude, the flexibility to remove names that might be detracting from performance. And in some cases, we have very systematic, rules-driven, quantitative models. And so with all of those, we start with our PMs and we say, look, if we were to actually implement this today, what would that look like? What kind of spreads would we anticipate? What would market makers think, right? So we'll call our friends in the industry, BTIG and others, to say, how, what does this look like to you? And through that, we'll make adjustments. Sometimes these require certain tweaks. For example, if you have a mid to small cap strategy and you're really dipping below names that are, 1 billion in market cap, we might caution you and say, look, those names could be harder to trade. It might limit the capacity of the fund. So maybe we don't have to make changes today, but as it grows, you might have to adjust that strategy. And so for some folks, that's a great problem to have. Great, we'll worry about the strategy when it's 500 million, a billion, but that's where we start. We just want people to know what they're getting into from the get-go.
Perfect. Thank you, Amrita. Ryan, First Trust has more than half of their ETFs in the actively managed wrapper. It's clearly an area of growth for your firm. Can you discuss how you come up with the ideas for all these actively managed strategies?
Yeah, so in one sense, we're agnostic in terms of whether we're active or passive. We've certainly adopted more actively managed funds recently, but the question that we start off with is, do we want to deliver, what's the best way to deliver this strategy or this asset class? Is it active? Is it passive? Sometimes it ends up being a passive strategy that tracks a more active index. Sometimes it's full-blown active management. But I think one of the important philosophies that we have as we're developing products is starting off by asking questions of our clients, of the asset managers, of the portfolio managers, the financial advisors that are primarily selling our products and using them to manage portfolios. Because we can come up with some really good ideas. They check off all the boxes for academic finance, and they could be fantastic processes. But ultimately, if no one's asking for it, and if you can't explain it in 30 seconds, those products, experience has told us, will fail. And so we start off the process asking our clients, is this something that would actually be helpful for you as you manage your client's wealth? And that's really been one of the guiding principles for our product development. Today we have something like 260 different ETFs, and some of those are full-blown active management in the traditional sense. Some of them are buffered strategies where we're using active management because it's just more efficient and easier, but it's very systematized, exactly what you're doing. And there's a whole spectrum in between. We started off with more fixed income because that was, we felt that was one of the easiest cases to make for active management. But we've got the whole spectrum of fixed income, equities, commodities, and we would completely agree that the trend is favoring actively managed strategies. I think, I looked at a statistic recently where it was something like 5 years ago, 2% of ETF assets were actively managed, and today that's about 8%. So that's pretty rapid growth over the last 5 years. Every quarter since then has had more actively managed ETFs launched than passive. So certainly that is where the industry is going, and we're fortunate to have been an early adopter. I think our first active fund was launched in 2012. So we've certainly been focused on that type of ETF.
I definitely want to hear more about the buffered strategy, so we'll have to touch base on that before the end of the panel. Mark, Kovitz launched their first ETF. It was a conversion of 2 mutual funds and a handful of SMAs. What decisions go into converting into an ETF structure, What does the process look like, and what does that ETF wrapper give compared to the SMA or even the mutual fund structure?
So I think to understand the decision process for us, that you have to understand the evolution of our firm. So when I started at COVID's 15 years ago, we were $2 billion, and we managed all high net worth separately managed accounts, which wasn't really scalable for small accounts operationally. So I wish I knew Ryan then, because 2012 we launched our first and only mutual fund for our strategy, which served us well, but ETFs weren't really understood, at least as far as I know. We just went with the mutual fund, served us well, but as the tax efficiencies became more glaring in the ETF wrapper versus the mutual fund, a few years ago we started to look into, okay, can we transition? And like Amrita said, like, is it worth the distraction? So we went down the road to try to understand what we could do to transition our mutual fund to an ETF, and it was an easy decision once we realized that we could transition 430 SMAs to that same ETF wrapper. So the mutual fund was 60 million at that point. We were able to launch our first ETF with 400 and some SMAs at 640 million. So those clients realized that tax benefit of rolling those low basis value stocks into the ETF, and kind of poof, magic, those, like, that basis just rolls in the ETF, and they get a non-taxable event. So that decision was pretty easy once we realized we were able to benefit our clients in that way.
Perfect. Steven, actively managed ETFs are growing. I gave the stats earlier, and Ryan mentioned the growth from 2 to 8%. As a firm at Goldman that has both active and passive, can you talk about what the role of active is and what that structure gives in flexibility?
Definitely. I think something that everyone up here would agree on is that the future is active. When you look at the ETF history, the largest incumbent issuers were largely known as passive or beta shops. And we really believe that the next phase of industry growth is going to come from active management. And you quoted some stats, Ryan quoted some stats. 77% of new ETFs launched this year have been actively managed. And despite being just an asset base of 8% of total ETF assets, they punch way above their weight class. Over a quarter of flows into ETFs this year in the US have gone into active funds. Now, in terms of benefits of active, investors increasingly turn to active management to navigate uncertain market environments. Certainly something we've seen over the last 2 years, whether it's been geopolitical risks, inflation, changing interest rates. And investors have also continually adopted ETFs due to a lot of the benefits that we all are familiar with: transparency, tradability, and tax efficiency. Now, Goldman Sachs Asset Management, first and foremost, we're focused on delivering whole portfolio solutions. And there's space for active and passive in those portfolios. But as it relates to active ETFs, something we're really excited about is Goldman Sachs Asset Management has a world-class active investing franchise. We have capabilities across every asset class, a global footprint, and it's something we've been doing for decades. So we're really excited about this, and something we're keenly focused on is bringing our active investor to the ETF wrapper. We think it's a trend that we're really well positioned to continue to deliver for our clients on and take advantage of in the future.
Thank you, Steven. So Rich, we talked a little bit about mutual fund conversions. What about mutual fund clones? When you were looking at launching a new strategy, when do you decide to use a clone of a mutual fund or do a variation of that particular strategy?
Yeah, I'm glad the lights are so bright because I can't see if there's anybody from the home offices at a major wirehouse here. But I think for most of the audience, especially if you're an RA in the audience, what you're really interested in is sort of the 5 Ps or however many Ps you take a look at. So you look at the people, you look at the process, you look at the investment philosophy, you look at obviously the performance. And so when I'm talking to the RA audience, we're really focused on, listen, this is the same people, the same process, the same investment philosophy that we've used either in a mutual fund or a separate account that goes back 10, 15, 20 years. And I think that audience really values choice. So you like the fact that you can now access that investment strategy in the vehicle that fits the needs for your clients the best, whether that be a mutual fund or a separately managed account or in the ETF wrapper. And certainly, the type of investment account helps with that decision-making process. When we have this same conversation with home offices, because of Reg BI, and I'm generalizing here, but I would say for the most part, most home offices don't like that choice. Because of Reg BI, they want one choice, they want the lowest cost, and perhaps that mutual fund that you launched 10, 15 years ago is entrenched in their platform. Now they're forced with a choice of like, well, why don't I own the lower cost ETF? So for us, when we launched our first 4 products, we tried to create some differences in the investment structure to help home offices, but not make them too different that it would affect the RAA's ability to look at the strategy. So what we did is, and there's a little bit of a new term in the industry, so we do have one product that's a straight up clone. We chose to clone one of our products because it wasn't widely distributed. It was a newer fund that we had acquired. It wasn't on a lot of platforms. But we've done with some of the other strategies what we call kind of a cousin. I don't know if anyone's heard this term in the industry, but it's kind of an ETF cousin. So it's those same people, it's the same process, same investment philosophy, but it has a couple subtle differences. So for example, our ultra short product can own up to 15% in the ETF wrapper in non-investment grade securities. So we think different enough that maybe allows the home offices to own both products and have a reason for owning both products. But I think for the most part, people try to stay away from clones because it does create some conflict at the home office.
Thank you. Amrita, you probably see new ideas weekly, maybe even daily, based on all the different clients that are coming to you looking to launch an ETF. Do you get the sense that we're running out of good ideas? And if so, what would the innovation look like in 2025?
So you, along with some of my fellow panelists, have shared some very interesting statistics, right? So you think about today, we have roughly 3,500, 3,600 ETFs listed in the United States. Compare that to 8,500 mutual funds that are available. So for those of us in the industry, we've spent a lot of time over the years talking about how the growth of ETFs parallels the way that mutual funds grow. And so if you just look at those numbers alone, that certainly suggests a lot of room for growth. I think all of us in this panel can point to very specific reasons why we think that's the case. For us at Biden, from what we're seeing from our clients and from folks that are approaching us, I'm realizing that we're just scratching the surface on active fixed income. Right, so over the last few years, we've seen a lot of incredible innovation in active equity, but active fixed income, not so much. And I expect that going into 2025 and beyond, active fixed income is going to represent a sizable portion of new launches in the active space. I would also not underestimate the continued trend of conversions, whether it's mutual fund or SMA conversions. So on the other track here, the ETF industry track right now, my colleague is on a panel talking about those conversions. They're called 351s because they're such an important topic for those of us in the industry. And almost all of those are active. And so I think those are going to be two major drivers for the growth of active in the coming years. So as an ETF person, I continue to be very bullish. I think this industry and all of our participants continue to have the ability to be very innovative. And so personally, sitting in this seat, working with almost 30 different ETF issuers, I'm spoiled. I get to see kind of the best of what people are coming up with right now.
That's great. Ryan, you mentioned buffered strategies earlier. I'm not sure how familiar people are with that, but over the last 5 years, they've become a very prominent part of the investment landscape. And First Trust has been at the cornerstone of that growth. Can you talk a little bit about what a buffered strategy is and how they offer unique exposure to investors?
Sure. Yeah. It's funny. Every once in a while, I'll hear the question like, "Are there all the good ideas gone? Like, where's the white space?" And it seems like every few years, over the last 20, I've heard that. And buffered ETFs, we started launching back in 2019, so about 5 years ago. But essentially, these are the same sorts of strategies that you would historically have found in like a structured note or a equity-linked CD or equity-linked note, something like that, where you're essentially participating in some level of the upside of a reference asset. In most cases, that's the S&P 500, but it can be the NASDAQ, it can be any index really. And you're capping your upside in exchange for a level of downside protection. So whether that's you give up or you don't participate in the first 10% of the downside or whatever the percentage might be, typically we're doing this in an ETF in a very transparent way. So we have a distribution force at our firm that had been distributing structured products for quite some time. And one of the objections that they would always come up against is, well, what about the liquidity? Do you have the ability to sell this before the note matures? And one of the wonderful things about the ETF structure and essentially delivering the same thing is that it is transparent. You do know which 4 flex options you're holding in the ETF, and you can get transparent pricing. And so intraday, you can make a trade based on the value of those underlying options that are in the portfolio. And so that helps to solve a problem. The other problem that sometimes we would hear is, well, when a note matures, that's usually a taxable event. Hopefully, it's a taxable event. You've got a gain. And again, one of the benefits of this ETF structure is that you're able to actually execute that strategy in a much more tax-efficient way because you can actually roll over those options as they head towards maturity. And so that's been another virtue of that ETF chassis. But it's been responsible for something like $22, $23 billion in net inflows for our firm over the last few years. And this is one of these areas that we think that there's all sorts of growth potential ahead. We're seeing other asset managers get into this space, and sometimes people ask, well, are you worried about the competitive pressures? And one of the interesting parts of that segment of the industry is that it requires some pretty a good level of education for people to understand what's happening. So we're happy to have more people come and tell the story of why these make sense and help advisors feel comfortable using them with their clients. But yeah, we think there's a lot of opportunity ahead for those buffered strategies.
That's great. Mark, you run trading at Kovitz, head of trading. You launched the ETF about 18 months ago. What have you seen as far as trading the ETF versus trading SMAs or mutual funds? Any major differences?
I mean, the first thing that comes to mind is price, transparency. Just being able to see live pricing in the fund that your clients own is a game changer. Not having to wait for an end of day NAV in a mutual fund world, being able to see your ticker on the New York Stock Exchange, or even like we invited clients and friends to the New York Stock Exchange to be able to see the big launch. It was a big deal for our clients. So I think just that price transparency was the biggest thing as far as trading goes. That, and also being able to partner with a lead market maker for our product to be able to provide that liquidity for us. Being able to tell advisors, it was a hard conversation that goes back to the education aspect of it. Like, if only our clients own this ETF, where does the liquidity come from? And it's hard to, it's a big adjustment for our advisors to understand how ETFs work, but it was worth it in the long run.
And one of the big things for ETFs versus SMAs and mutual funds is the tax efficiency. You can do custom in-kind rebalances on actively managed ETFs.
Absolutely, it was that was a learning curve. Understanding all the death by baskets. We didn't understand the create, redeem, standard basket language, but over time you start to figure it out. And yeah, being able to do that custom redeem to deliver the low basis shares out of the ETF and just I don't know, it's magic. The way I explain it to our clients, it's just magic.
Well, I think Rule 6011 was instrumental in leveling the playing field for those various different ETFs and opened the floodgates for actively managed funds to be able to have those tax efficiencies.
Yeah, and one of the hardest pain points was to try to educate our end client. Like, okay, you're used to 35, 40 actual equity names in your portfolio, so you go to do a portfolio review, and it's you transition from 30 to 40 names, and okay, this one went up, this one went down, but now I just have this EQTY staring at me. Like, so more marketing to be able to understand what's actually going on in the underlying portfolio for our end client. But I mean, the tax efficiencies helps cure all.
Absolutely.
That was a veteran ETF move right there, dropping the ticker into the
I
president.
thought we had a ticker.
It's available on New York Stock Exchange.
Stephen, historically, when you think about actively managed ETFs, it's fixed income or equity. We've heard various different products that have launched between single stock levered ETFs to buffered strategies. Can you talk a little bit about where Goldman sees the growth in the actively managed strategies?
Definitely, and I think if there's one takeaway for everyone from this panel today, it's that there are many different flavors of active management, and no two active strategies are created equal. And you can see that in what we've launched in the last 12 to 13 months. We've launched 7 active ETFs across 3 distinct different types of active management. So we have, GSC, or traditional fundamental high conviction stock pickers portfolio. And then we have 4 active municipal bond ETFs that we launched over the summer. And again, that's plugging in our award-winning, decades-long municipal bond franchise in the mutual fund and the SMA wrapper into, our active ETF business. And then about a year ago, we launched 2 dynamic buy rate strategies that are a different flavor of active, where we're blending, a transparent, passive, indexed core equity portfolio with an active options overlay to generate income, GPIX and GPIQ. Sorry, I have to throw them out there. But many different flavors of active. I think that's going to continue because of the benefits. We think that's going to continue because of the benefits that active management affords investors and that the ETF wrapper affords investors. And looking forward, you talked about single stock levered, buffered ETFs we've heard about today. Something that we're very focused on and that we expect the industry to continue to innovate on is marrying the ETF wrapper, which is traditionally a very liquid wrapper, with alternatives, which is a very illiquid asset class. So we're very keen to be on the forefront of that. It's something we're spending a lot of time thinking about, and it is where we think we see the puck going.
So I'll give a jump ball here, so chime in if you have any thoughts on the particular question, but S&P 6,000 all-time highs, does that bode well for actively managed products because investors are thinking that the passive flows might be overvalued or there's not much room for upside?
I'll give my opinion, and the answer is yes, and on a couple levels. One, I think people think about risk management when it comes to active management. But 2, when you consider the concentration, the level of concentration in market cap weighted indices today, with the market at those levels, active management, one of the benefits is you can tone down some of that, and maybe you don't want to go all the way to an equal weight, or maybe you just want to bias your portfolio using factors or something like that, and make adjustments in real time. I think those are all virtues of an actively managed strategy. So I do think that it's really, really hard as an active manager to outperform the S&P 500 when it becomes concentrated, You've got the highest quality, best stocks at the top. They're growing earnings, growing revenue, but that doesn't last forever, and eventually the pendulum swings in the other direction.
I think Ryan said it earlier, but you asked about equities, and we could debate, equities, active, passive, probably for the rest of the day. But when it comes to fixed income, I think the results are pretty clear that active management works. And would you just want to own the ag, or would you want to look at all these choices that you have out there, across the fixed income spectrum to really build a customized solution for your clients' portfolios? So I think active fixed income is that's where you see the launches, and I think that's where you continue to see the flows.
Very helpful. I think we have about 5 minutes left, so I'll leave that for questions. I'm sure there's some questions in the audience based on what we've heard today.
I have a question for Ryan. Thank you. Yeah, this question's for Ryan. So I interned this summer on the structured investment desk at JP Morgan, actually. So it was interesting hearing you talk about putting the buffered notes into ETFs. Is that also possible with a fixed income note, so something like a auto callable yield note? Are you also able to put that into a ETF wrapper?
Yeah, the simple answer is yes. You can anything that has the underlying securities that you would use, you do have the capability, and we're actually in developing some products that are in the fixed income side now. You can also use, anything you can use options for, you can also generate income with. And so we've got a number of what we call our target income products, which may have some level of downside protection or not, depends on the actual ETF, that can boost your yield and create income, whether that's for an equity structure or a fixed income structure. But there's all sorts of white space, all sorts of areas that you can use to develop products.
I'll ask a question. I don't know, can you hear me?
Yeah.
But if you can hear me. I mean, first of all, that was terrific. I learned more in the past 45 minutes in terms of just the growth of ETFs in general. Break it down to the advisor level. It seems like the industry is growing so fast, and now I'm an advisor. I'm managing X amount of millions or billions of dollars. You have so much more inventory. How does the advisor really decipher from just the sheer number of growth? How do you think the industry is going to evolve? Because more doesn't necessarily mean better, right? So I'd love to hear what's the industry doing to help the advisor figure it out in terms of just the number of products out there.
Yeah, I have a few thoughts on that one. A ton of choice out there in the ETF market, just like there's a ton of choice out there in the mutual fund market. And the way I like to describe what an ETF is to my friends who don't, work in the industry, is that it basically is taking stock picking or bond picking out of the equation. And a large engine of growth of the ETF industry and where we think it's going to move forward is with model portfolios. So a model portfolio takes ETF picking out of the equation, where you're outsourcing some of your fund selection to a Goldman Sachs or a BlackRock or a JP Morgan and other providers of model portfolios. We're seeing a lot of advisors use model portfolios for their core portfolio holdings or a certain account level for their clients. And we'll also see advisors use those model portfolios as the core and then select ETFs they like to use as satellite positions where they'll overweight a certain theme or a sector or add to a defined outcome strategy in a certain sleeve. So we definitely think model portfolios are going to continue to be a driver of growth for advisors and in ETF assets.
If I can just add to that, I completely agree. The models have been really helpful in helping to narrow down the universe. But I also want to point out that it's actually a virtue for an advisor to have the ability to get to know these products. If there were fewer products to choose from, what does an investor need a financial professional for? If you have access and you can better understand the inventory and you can maybe make better recommendations than somebody who just picks, SPY or something like that, I think that's something that advisors can now bring to the table in a way that, as the inventory expands, is better for the end investor.
I would just add one more point with regard to volume. Of course, up here, we're a little biased. We're very excited about the growth that we believe is pending. I will say the ETF marketplace has gotten a lot quicker at declaring winners and losers. So as we keep talking about the growth of new ETFs, there's also the closures. And just as you would see in a more mature marketplace, you are seeing closures, or the number of closures, increase over time. It's becoming increasingly expensive for sponsors to keep their funds open. So if they don't believe they're going to achieve growth in a reasonable amount of time, right now, 18 months is really kind of around the time that people start to question, all right, is this going to happen or not? And so the folks that really succeed, that grow, they're doing something right, but they're also investing a lot in sales and marketing and really trying to target all of that to the financial advisor. So every ETF issuer, if they know what they're doing, they're designing their products, they're launching their products, they're marketing their products with a financial advisor in mind. Sometimes I almost argue at the expense of retail, which is also a huge market for ETFs. And so I'd like to say that issuers are really keeping the financial investor in mind at financial advisor, in mind at every stage of the product life cycle.
And one thing I would add is I think education is paramount. Doing panels like this, but also the capital markets teams working with the end advisors to give them the education they need on the various different products and how those actively managed ETFs can complement their passive portfolios.
Thank you.
We'll do one last question.
I have a question, yes.
Real quick, I guess where do you guys see open-end funds like in 5 years? Is there even a need for them aside from 401ks? Is there a need for open-end funds?
Yeah, I think there'll still be a need for open-end funds. I mean, clearly, like the where the account is located is going to play a big role. But if you think about an investor that just only knows mutual funds through their 401k, when they roll that over, they're going to be comfortable with mutual funds, or it's going to be still in a tax-deferred vehicle. So there'll still be a need for for mutual funds, without a doubt.
I think the other case might be for small contribution, someone who's someone who's investing for the first time, putting in $100 out of their every paycheck. That doesn't work as well if you've got to pay for trading costs or something like that. So maybe a mutual fund fits better. There was a question back there. I don't want him to get
one more
missed.
question.
Yes, thank you. So I'm a financial advisor, and I use most of the time I use SMAs and I use model portfolio to choose different SMAs and ETF. So the question is, when you convert SMAs to ETF, can you tell me the impact in terms of cost, investment returns?
I think I caught most of that. So the SMA has to mimic the fund that you want to create, right? So the underlying holdings of those SMAs has to mirror that ETF that you want to launch. So in our case, we had a mutual fund that was our single strategy, and all of our SMAs had those underlying holdings, right? So the difficult part is there's a reasonability check for each of those SMAs, and and all of those underlying holdings move intraday. So once we knew we were doing this transition, 6 months would go by before we actually launched that ETF. And it was like herding cats. One stock would go up 10%, so like the quantity of shares that you're delivering to the ETF would go up or down. You'd have to convince advisors that, we launched in December, have to convince advisors to not run tax loss trades, because those accounts are, they're taxable accounts. So it's understanding that they want to, take those losses, but those are being delivered to ETFs. So it's a moving target into launch, and all those underlying holdings have to mirror what you're trying to launch. So depending on what your SMAs look like, that that comes into play.
Thank you, everyone.